Hello, welcome to CGE tutorial. This video focuses on monetary policy. It's about how governments manage their money supply to influence the economy. Monetary policy is a powerful tool. It can stimulate growth or curb inflation. Understanding it is crucial for anyone interested in economics or finance. Monetary policy centers around the actions of a central bank. In the US, this is known as the Federal Reserve, often called the Fed. In India, it's the Reserve Bank of India, or RBI. They all more or less function in the same manner. The central bank's decisions about the money supply directly affect interest rates. They also indirectly affect borrowing, investment and spending. These ultimately shape the overall economic landscape. Monetary policy aims for stable prices and total employment. When prices rise too quickly, we call it inflation. This erodes purchasing power of each unit of currency. The central bank aims for a balance, promoting sustainable economic growth without triggering runaway inflation. Understanding these concepts is essential for informed economic decision-making.
Central banks cannot willy-nilly print money and distribute among random people or companies. Instead, they have a variety of tools which they often use to manage the money supply in an economy. One primary tool is the adjustment of interest rates. The central bank can raise or lower the federal funds rate. In India, it's more commonly referred to as the repo rate. The repo rate, RRR, is the interest rate commercial banks pay to the central bank or each other for overnight loans. Changes to this rate ripple through the economy. They influence other interest rates on loans and savings. Another tool is open market operations. This involves buying or selling government securities in the open market. When the central bank buys securities, it injects money into the economy. Selling securities does the opposite, withdrawing money and slowing down the economy. To curb inflation, central banks can increase reserve requirements, which are the minimum reserves banks must hold. This reduces the money banks can lend, decreasing the overall money supply and inflation. Lowering this requirement frees up more money for lending, pushes inflation upwards.
Interest rates are a cornerstone of monetary policy. They act as the price of money. They directly impact borrowing, lending and investment decisions throughout the economy. A higher repo rate helps to curb inflation. When the central bank lowers interest rates, borrowing becomes cheaper. This increases inflation. This encourages businesses to take out loans for expansion. It also makes it more attractive for consumers to borrow for purchases like homes and cars. This increased borrowing and spending can stimulate economic growth. Conversely, when the central bank raises interest rates, borrowing becomes more expensive. Businesses may postpone expansion plans when faced with higher borrowing costs. Consumers may delay large purchases. The central bank's decisions on interest rates are based on careful analysis of economic data. Their goal is to maintain a balance.
Let's talk a bit more about open market operations and quantitative easing. Open market operations involve the buying and selling of government securities in the open market, impacting the money supply.
Government securities are financial instruments, such as bonds, treasury bills, and notes, issued by a government to raise funds. They are considered low-risk investments since they are backed by the government's credit. Investors receive periodic interest payments and the return of the principal amount upon maturity.
An example of open market operations is when the central bank buys government bonds from commercial banks to increase the money supply. This purchase raises the bank's reserves, allowing them to lend more to businesses and individuals, thereby boosting the money supply. Conversely, when the central bank sells these government securities in the market, it withdraws money from the economy, reduces bank reserves, making it more difficult to lend. Quantitative easing, or QE, involves buying long-term government bonds or other securities to lower long-term interest rates and encourage lending and investment.
The Reserve Bank must maintain a healthy balance of growth, inflation and employment. Monetary policy involves a delicate balancing act. Central banks aim to promote economic growth while keeping inflation in check and supporting employment. For example, lowering interest rates can stimulate economic growth and reduce unemployment, but if taken too far, it can also lead to inflation. Conversely, raising interest rates can help to control inflation, but if interest rates rise too high, they can stifle economic growth and lead to job losses. The challenge for central banks is to find the right balance.
So, what is the crucial role of central banks? Central banks play a pivotal role in maintaining economic stability. They act as independent entities, free from political influence in their decision-making. This independence allows central banks to make decisions based on economic considerations rather than short-term political pressures. Central banks use their tools to moderate economic cycles, aiming to smooth out the booms and busts inherent in any economy. They also act as lenders of last resort during financial crises, providing liquidity to banks and stabilizing financial markets. By understanding the tools, objectives, and impacts of monetary policy, individuals can gain a deeper understanding of the forces shaping the economic landscape. Please share your comments, like and subscribe for more.